We do that with Sarah Malik, who is Nuveen CIO. And Sarah, what are you thinking so far? A lot of earnings to kind of wade through, a lot of different circumstances, but is there some sort of message for the markets that you take out of it?
I think what we've seen year to date is a typical January effect where there's two main events of the Fed and payrolls, which is causing markets to have a hard time following through. So in terms of the Fed, they're walking a tightrope. The market widely expects them to moderate rate hikes to 25 basis points, but we expect them to balance that with hawkish commentary because they need to make sure that they don't become too bullish and ease financial conditions even more. Payrolls, we think we could see a beat again this month, 250,000 payrolls, maybe even more, due to strong demand, tight supply, and continued hiring in services, and following that with a bump in wage inflation. So all of that together, I think, is why the market is going to have trouble continuing the rally that we've seen in January so far.
Yeah, having said that, we are looking at the futures this morning, trying to rally back pretty sharply. The Dow's made some improvements, so's the S&P, so's the NASDAQ. I don't know if it'll actually go positive today or not. But we did hear from Jim Chanos. He talked to one of the programs yesterday, Closing Bell, I think, was on, and talked a little bit about how he's worried about how the market has gotten more expensive. Now, he is a short seller, but he doesn't often make comments on the broad market. He pointed out that we're looking at earnings at 18 times forward. We're talking about 18 times forward earnings right now, and that's not as cheap as we had been just a month ago.
Valuations are one of our key concerns. One of the issues is that the market is basically pricing in one of the most optimistic scenario, which is a soft landing. Now, add to that risks around inflation, which is still sticky, recession, earnings downside. We're happy to see earnings estimates moving lower, but revenue growth is still expected to be in the mid-single digits on the positive side this year. That's a risk. And then, of course, the debt ceiling, another shorter-term issue. But if you look back in 2011, debt ceiling issues caused the markets to decline in the double digits. And with the polarization politically this year, I think you could run into an issue where there's a lot of arguing over the debt ceiling, and also if we have to cut spending going forward, that could lead to an economic recession being exacerbated. So all of those are issues we have to deal with as 2023 goes on. We're not pricing those in when it comes to valuations.
Are you a buyer here?
I think at this point, we're looking for quality and defense, so I'd be buying on the defensive side. Dividend growers within equity. We like fixed income over equity, where you can get historical equity-like returns for lower volatility. Infrastructure stocks, we like those, tend to have more recession-resilient factors behind them, like waste management, utilities. So two key factors to watch for: quality, defense. Those are companies we think can continue to do well. Something like McDonald's, which is a safe haven stock, I think that could be an outperformer if the market starts to give up some of this rally that we saw in January.
You know, the buy on the dip used to be the thing to do. It has not been, at least not for the last year. Are you back into that idea? If these are stocks you like, if they do drop down, then you'd buy them because you like valuations all of a sudden? Or is it far more complicated than that at this point?
If there's a high quality stock, I would be looking to buy on the dip. But more broadly, we're more in the sell on the rally camp when it comes to equities, because I just don't think valuations reflect reality. Earnings are disconnected from reality in terms of consensus estimates going forward. It's obvious that the market and the Fed disagree in the sense that the market is more optimistic on the Fed pausing or pivoting. I don't think the Fed's going to be looking towards pivoting anytime soon. And a pause could be a long pause. And there could also be a longer tail of these 25 basis point rate hikes going forward. I think that's not what the market's considering. So all of that together makes us more of a seller.